Podcasting since 2005. This is the King of Podcasts radio network. kingofpodcasts.com.
2 words, private money. Welcome back to Podcasters Row. King of Podcasts here with you. The website is kingofpodcasts.com. Thank you for joining me for the program. And again, as we continue to move along in our series of talking to great podcasters out here, learning and expanding the spectrum of what kind of podcasts are out there, and learn more about what they're all doing and how they all make it work. So one of our previous guests on the program was Patrick Francie. He hosts the Everyday Millionaire podcast and Mindset Matters, 2 different shows. Mindset Matters he hosts with his wife. And he was happy, nice enough to go and introduce us and refer another guest to our program. And let me go do that introduction right now. So he is widely recognized as the Private Money Authority, a seasoned real estate investor, coach and entrepreneur, carving a niche and teaching others how to fund deals without relying on traditional banks, personal credit, or hard money lenders. And there's more I'm going to say to it, but we'll get all into it. I'm here with the host of Raising Private Money, Jay Conner. Jay, thanks for being on with me.
George, my Lance, thank you so much for inviting me to come along and talk about my favorite subject that I'm so passionate about, that being private money, because private money is the one strategy that's had more of an impact on my real estate investing business than anything else since I started all the way back in 2003. I'm excited to be here, George.
Thank you much, Jay. I got to ask you this question, and this is not to be a diss or anything like that, but do you ever get confused with Dave Ramsey? Because everybody wants to go ahead and say, oh, here's a money guy talking with the drawl. There, that's him right there. Is anything that you ever get that kind of distinction?
No, I don't.
Right.
I don't think I've ever been compared to Dave Ramsey. At least if I have, I don't recall.
Well, it's not as if, there's one thing for certain people that have, a certain platform, but only so much time to go and give. There's something about when you're doing it on podcasts and you want to have the time to go and talk more about, just not just taking little snippets here and there and kind of just taking what in between long commercial breaks and trying to go and get something from whatever feedback you see on a radio show. It's like, let's just say like this. There are shows on radio that almost treat themselves like barter programs. Like they're kind of paid programs. And there's only so much information to give. But with you, I know that you really want to go ahead and give details about what is initially a system blueprint on being able to go ahead and get private money. So now, for your own background, you're closing an average of 3 real estate deals per month. You have an average profit of $78,000 per transaction. And you've raised over $8 million in private money. And the point here gets to 2003. So that's with your system. But the thing is that you're giving us time to go ahead and really learn the system and understand what you're doing in this podcast. So current actionable strategies, not outdated theories, and you're offering resources. And you have a book that, was telling me just before we got on that you'd like to go and offer to listeners called Where to Get the Money Now to Empower Fellow Investors. And the core mission is to ensure that lack of funding never prevents an investor from seizing a profitable opportunity. So we'll bring up the book later on the program. But Jay, what is it about being able to get this kind of money? Because we know there are people out there get rich quick. Stocks are not going to help them out. They want to try to flip houses. There's a lot of different ways that people want to find a way to go ahead and get ahead. But, they don't want to go the route of just trying to go ahead and save over 30 years to retirement to get to $1 million and have a nest egg. People want to go and get there fast. So what are you telling the folks on your program?
So first of all, let me talk about the distinction between private money funding and, say, institutional money.
Okay.
In my first 6 years, George, that I was investing in real estate, and my focus is single-family houses. Now, you can use private money for any kind of real estate, land, self-storage, commercial, apartments. My focus is single-family houses. And the way I do it, the Security Exchange Commission is never involved because I'm not raising money for a fund. Everything we do is what's called one-offs. Well, what in the world is a one-off? A one-off is you've got a single-family house property, and then you have a private lender or maybe a couple of private lenders that are funding that deal. So the distinction is that private money or private lending, the investor or the lender is a human being, just like you and me. right? I got 47 of those people right now that are investing in our deals, loaning us money on deals, private lenders. So we're not talking banks, we're not talking institutions. And here's another really, really important distinction, and that is I'm not talking hard money. So a hard money lender is institutional money. Typically, a hard money lender goes out and raises money from private lenders, from private investors, human beings that invest in their fund. And then the hard money lender turns around, raises the interest rate from what they're paying the private lender investor. They charge points, origination fees, et cetera. Well, the reason it's so important to make that distinction between hard money and private money is because a lot of hard money lenders out there these days call themselves private lenders, and they're really not private lenders. They are an institution. By the way, I'm not poo-pooing hard money lenders. I say have as many relationships in place as you can, but I got 20 reasons why I love private money as opposed to institutional money. The interest rate is much less. There's no points. I always bring home a big check when I buy a property. I'm always able to borrow more than I need to purchase it. And so, traditionally, you got to take a down payment to the bank or a hard money lender. There's never any down payments in this world. And the question is, who wants to get paid to buy houses? We always bring home a big check. So we're doing business with individuals that are either most of the time investing money with us from either their investment capital, liquid investment capital, and or their retirement funds. So there's this thing called self-directed IRAs. And a self-directed IRA is approved by the IRS to where an individual that has retirement funds can move those funds over from wherever they are in the stock market, in a 401k or whatever, tax-free, no penalty, whatever, no tax effect, and then use retirement funds to invest with us. So, the first 6 years that I was investing in single-family houses here in Eastern North Carolina, all I knew to do, George, was go to the local bank, get on my hands and knees, and say, please fund my deal, and had to provide financial statements, and the banker made me pull up my skirt to show my personal assets, and
go through the embarrassment of trying to get the loan and trying to get the funding only to be rejected. It's like it's not worth going through the time. I want to ask you real quickly, when it comes to the real estate that you're actually buying and investing and selling back, what would you say about those that might not want to have land or property or lots that have not been built versus having those that are built? Because I know with my family, we've done investment in lots in areas that we know of communities that are going to get built up pretty quickly, and it's done good here and there. But that's the point, is like right now, okay, for instance, we have lots in Ocala, and we know this being Ocala, Florida, is getting built all over the place. There's so many new communities coming up. There's that part of, we have lots that are now increasing in price, but it's like sat on it for a while, put our own money into it, and we're waiting for it to go and come back to it. At the point, it hadn't made it to a certain point where we can make a profit on it. We're just trying to get to even now, but it's eventually going to get to profit. What about that idea of built versus non-built lots, land, or property?
Great question, George. So when a private lender is loaning money on a vacant lot, here's what it comes down to. How much are you going to loan as a private lender on that lot? So we don't borrow unsecured money. We always collateralize the promissory note with, in North Carolina, it's a deed of trust. Most states call it a mortgage.
Yep.
So we give our private lenders the same protection as the local bank would get. We actually name the private lender as the mortgagee on the insurance policy. So if there's ever a claim on that house that's already there, then the check is made payable to the private lender as well. But back to your question. So it depends on the exit strategy. So I got a lot of real estate investor friends that are flipping land.
Right.
They'll buy the land, they'll flip the land. And so that's a pretty easy answer there. Yes, borrow private money secured by that lot. However, the different scenario is what you just talked about. You're going to buy the land, and your intention is to build on it and improve on it. So as a private lender, if the private lender is loaning money on that lot, they're going to get the collateral, right? They'll get the collateral. They'll get the mortgage or the deed of trust securing their note. However, if they're loaning money for the build, for the vertical, in addition to what the value of the land is, then you got this thing. It's a 5-letter word that starts with a T called trust.
Mm-hmm.
So that private lender is trusting the borrower, the real estate investor, to improve that lot up to even more value than what they would be loaning. You see, I don't borrow more than 75% of the after repaired value of a property. Now, I'll buy it at 50% of the after repaired value. For example, let's say I'm looking at a single family house. I'm going to use small numbers because it's easy to understand.
Mm-hmm.
Let's say the after repaired value is $200,000 on this single family house. And when my
Pretty
definition
cheap,
of
by the
after
way. Let me
repaired,
tell you that. Compared to what we got over here in Florida, I'm in West Palm Beach, Florida, and the houses are easily going over $500,000.
oh yeah, absolutely. And so in this example, I'll borrow up to 75% of the after repaired value, which would be $150,000. Mm-hmm. Now I'm going to buy that house all day long if it needs renovation for $100,000 or maybe even less. So my private lender is counting on me to improve that property, which I have over 500 times now, over 500 of these houses I've done. But when you're looking at land, the trust meter is like straight up there between the private lender and the borrower. Because if the real estate investor does not perform, private lenders hung out to dry, right? If they don't improve that land. So it really comes down to what's that relationship look like between the private lender and the real estate entrepreneur.
Yeah. One of the other areas I always thought about if I had the money is there's a common practice, obviously, with, let's say, in foreign countries. Say if you're from Brazil or from Latin America, South America, something like that. And there are banks that they have within their countries that it's just not worth putting the money in. Rather go and go to another country and invest in property and just hold on to that and don't put the money in the bank. Just put it in a property. See what happens with it. So, for instance, here in West Palm Beach, where I'm at, downtown West Palm Beach, they're building rough shot over here. Ken Griffin, Jeff Green, Stephen Ross, all these billionaires just building condos that are like 20 stories high all over the place. Of course, West Palm Beach, Fort Lauderdale, Miami is doing all that. I don't expect any of all those condos and all those buildings to be fully occupied. There must be people right now that are probably going ahead and buying apartments or condos from there to hold because they just want to put their money in that because they know the resale value on that is going to be good. And if they get the right price, they can make more money on their investment. What about that part of the idea of why your system would be good? Because people just want to not put their money in the bank. You have so much to put in. I mean, in Palm Beach as well, the island over here, you got billions of dollars. You're going to buy a property because you'd rather go and buy a property than put it into some bank. They're going to take and shave off a certain amount off the top.
Well, we know history proves it. The longer you own real estate, the longer you own a piece of real estate, the more money you're going to make. Yeah. Now, is real estate cyclical? Absolutely. Yeah. I've already lived through 5 cycles myself. So if you're going to buy and hold, you definitely want to have a strategy that you're going to buy and hold for the long term. I mean, look what happened at values of properties in 2007 and 8 and 9. Conversely, look at what's happened to value of property since COVID came along. I mean, crazy exponential, growth. So again, if you're going to hang on to properties, it's definitely you're going to want it to be a long-term play because, I mean, there's nothing else over the long term that has created wealth for people more than real estate.
Talk about the risk. For those people, okay, you mentioned 2007, 2008, the subprime mortgages that were being sent out. For all these people that thought, we're going to go ahead and flip the house. We got the low mortgage payments on the first year, but then skyrockets and balloons second and third year, and they all thought, oh, we're going to get this flipped in 1 year, and then they got held their hand, and they're drowning in debt. And, a lot of houses in foreclosure. We still got them all over the place now. What kind of fortitude do you really need to have financially for anybody to really be into this, to go ahead and go gather private money? Because you got to use some of your own money to get into this.
Actually, you don't have to use any of your own money. I've got in my community of real estate investors, my high-end mastermind group and my platinum coaching clients, a lot of them starting out, it's all funded with private money, right? Mm-hmm. So they're not having, now, do you need some money for marketing? Absolutely.
Yeah.
Absolutely. But I mean, as far as money and operating overhead, of course. Mm-hmm. But I'm talking about as far as money for the properties themselves. Private lending does all that funding, the purchase up front, the renovation up front. And if you're buying it right, you can pull some equity out as well, right? But back to your question, what are the risks involved? In fact, let me answer that question both ways. What's the risk involved for the real estate investor? What's the risk involved for the private lender? Because no matter what you do, there's risk. You get in that car and get out on the road, you just risking your life right there, right? So there's risk in everything we do. So let me start with the real estate investor. I can tell you, so I do a lot of flips. I do a lot of renovations and rehabbing. And the most common mistake that I see real estate investors making, particularly newer real estate investors, is they pay too much for the house to begin with. Look, HGTV has made a lot of people go broke, right? Because HGTV, the only thing about reality TV is that there's nothing real.
No, right. And there's so much that is being put into like the delusion of like what you can build of a house and what you can do with it. I don't understand the thought process. And also it's just that people are getting themselves into houses with no money, with no collateral whatsoever. They might get the loan, but they really can't afford it.
Yeah. So they pay too much for the house. You see, the secret sauce really is not in estimating renovations and repairs to the T. I mean, I've rehabbed over 500 houses. Not one of them have ever come in on budget exactly. Murphy lives in every house. And sometimes Murphy's cousins and aunts and uncles show up as well. And if you don't know who Murphy is, I'm talking about the guy that creates chaos, the fictional character that we had a foundation problem, didn't even know that. So it's really not my repairs on houses are either $30,000, $40,000, $50,000, or $60,000. And that's as close as I need to get and you need to get. The secret to success is buying the house right. You got to know your formula. I mean, here's another mistake, George, that I see new real estate investors make. They let their emotions get involved as to what the maximum offer should be on a property.
Yeah.
And so here's a writer downer. The math makes the decision. It's black and white. That's all there is to it. So what's my formula? Well, the formula I use for the most that I will pay on a house is I take the after repaired value, which, by the way, my definition of after repaired value is the home is absolutely beautiful, looks new, smells new, ready for Southern Living magazine pictures. That's the definition of after repaired value. So I take the after repaired value, which I get that from my realtor, by the way, and I multiply that times 70%. If the after repaired value is less than 300 in your area, all of them are over 300. So I take the after repaired value, multiply times 80%. So that accounts for my carrying cost and my profit. And then I subtract from that estimated repairs. That equals what we call maximum allowable offer. And then on houses with an after repaired value over 300,000, I subtract an additional $20,000 for the unexpected. And that's even after getting a home inspection, so you know exactly what you're dealing with. So let the math do the decision. The risk for the real estate investor is paying too much and not being trained educated or working with somebody starting out that knows what they're doing. For goodness sakes, don't make the stupid mistake that I made all the way back in 2003 when I started this business by myself.
Right.
I was relying on my past experience in the manufactured housing or mobile home business down there in Florida. You know all about mobile homes.
Oh, yeah.
And so that was my previous experience. Well, don't rely on previous experience. Get with somebody that knows what they're doing. So that's the primary risk to the real estate investor. Now, what's the primary risk for the private lender that's loaning the money? Well, let me give you the list. Here's the checklist for a new private lender that's never done it before. Number one, do not loan money unsecured. Period. Hands down. Do not take a promissory note, and, that's all there is to it.
Right.
You want that promissory note collateralized by the property that you're loaning money on. Number two, how well do you know the borrower, for goodness sakes? How well do you know the real estate investor? Is this a person of integrity? Is this a person that does what they say they will do? And is this a person that knows what they're doing? Right? Right?
Yeah.
So how well do you know the operator? Next point, conservative loan to value. I already said it. As the borrower, I don't borrow more than 75% of the after repaired value. So on that little $200,000 house, I'm not going to borrow more than $150,000 of that after repaired value. Okay. Another checklist for you as the private lender: require the borrower, the real estate investor, to name you as the mortgagee on the insurance policy. So if there's any claims against the insurance policy, the insurance company is going to make the check payable to you, the lender, the mortgagee, and to the real estate investor that owns the property. Gives you another layer of protection. Next point, require to be named as the lender on the title insurance policy in case there's any title issues down the road. Another requirement, for goodness sakes, do not wire money to never wire. Did I say never? Wire money directly to the borrower, for goodness sakes. You wire your money, maybe it's coming from investment capital, retirement funds. You wire your money as the lender directly to the closing agent, either the title company or the real estate attorney, whoever's closing deals in your local area. And that money's not going to be dispersed until closing happens. It's on public record, and everybody is protected.
I want to fall back up on what you talk about with self-directed IRAs. You mentioned that very early on. So self-directed IRA retirement accounts for funding, and somebody's retirement, put it into it, take it out of some kind of an institutional fund. I know for me, I have an investment in, ETF for precious metals and on the S&P 500. It's done pretty good so far. I've had it for about 18 years now, and it's turned around pretty good. It's about 40% yield so far since the beginning. So I didn't put $25 into it, and now it's grown into 5 figures. I'm pretty happy about that. But how often have you had people that have been willing to go ahead and consider lending for real estate and have those IRA holders make the conversion to put that money into property? Tell me about that and what you've been able to tell people to kind of convince them or persuade them that this is a good course of strategy.
Sure. So I've got 47 private lenders right now.
Yeah.
Now, if you've never raised capital, you don't need 47 private lenders, right? Start out with one or two. Yeah. My very first one was $250,000, which quickly became $500,000. Mm-hmm. And so the reason I bring that up is that over 50% of my private lenders are using their retirement funds. They're using their retirement funds to invest in our deals. So why do they like to do that? Well, they like to do it because all the returns, all the interest that I am paying my private lenders that are using their retirement funds, now in a self-directed IRA company that I recommend they use. I've been using the same rep for 8 years now to get my deals funded, is all the interest that they earn is either tax deferred or tax free, depending on the type of retirement account that they have. Secondly, they love it because it's a way for them to get involved in real estate and they don't have to do anything. Like, they don't have to find deals. I mean, for goodness sakes, I use 7 different vendors just for Google pay-per leads of motivated sellers. And so I do direct mail campaigns. I do outbound calling. My team.
Oh, yeah.
We do outbound texting. We direct mail every person that's in pre-foreclosure. I've been doing that since 2004, leading with a servant's heart, helping those people get out of distress and putting money in their pocket, help them get back on their feet. But a private lender doesn't have to do any of that. A private lender is totally passive. All they do is sit back and watch their account grow. Yeah. That's it.
One other thing I got to mention, well, the way you present yourself, I mean, obviously, even for a podcast, you give me a pastor vibe anyway, because you really are like, you're on the pulpit right now. I can see a big, thick Bible in your hand right now, just kind of like going along. I don't want to see Jimmy Swaggart or Oral Roberts, but I was old enough to remember those folks.
Thank you very much.
Well, it's because you make.
Hey, look now, George. We just dated ourselves when you said those 2 names.
I'm sure. Oh, I could say Robert Schuller if you want to go that route. I mean, you can go as far as you want. But I'll say this too: that you talk about your Christian grounding and the fact that it's a personal foundation for you to manifest your day-to-day operations. So, talk to me about that part of why it's important that you want to put that up front and forward for people to know that.
Yeah. Well, one reason that I very quickly and unashamedly profess my Christianity and a follower of Christ is because, first of all, whether you are or you aren't, or whatever you are, or maybe you're nothing, I really believe, George, and you probably do too, the people that really enjoy life, are happy, are truly joyous and successful, is they are authentic, right? They take their filter off. We all walk around with filters on. We all got our filter on. Take your filter off and let people know, what are your core values? Who are you? Yeah. What do you stand for, right? And what that does is that, I mean, regardless, no judgment here. I mean, no matter what you are, when you are authentic and you really let people know where you're coming from, what that does is it attracts more people in your life that are like you, and it actually repels other people from you that are not like you. And that's beautiful. I mean, George, I don't know who came up with this phrase or saying that opposites attract. That's the most stupid thing I ever heard in my life. I want to be around people that are like me, the same core values. And so when you attract people into your life and you share with them what you are really all about, then y'all going to be speaking the same language, right? Yeah, I mean, you're going to be coming from the same point. And so I share that to be authentic. And it also explains why everything that Carol Joy, my wife, and I do in our business and in our personal life, it's everything. It's all about leading with a servant's heart. And, this world ain't about me. This world is not about me. This world is about everybody else. And so how do we lead with everything we do in our business as a servant's heart? Well, for example, I mentioned a moment ago, we direct mail every person, family that's facing foreclosure. And you know what, George? Almost every one of those people that respond to our letters will sell to us for what they owe, right? They'll sell to us for what they owe. But you know what, George? We don't buy the properties for what they owe, for goodness sakes. Here's my question. If I'm averaging, which I am, the intro, I need to update my intro. My average profits now are actually $86,000 in the past 12 months. Well, and I don't say that to brag. I say that to make a point. If I'm averaging $86,000 a deal, for goodness sakes, can I not put $3,000 or $4,000 in the pocket of the seller of those people that are facing foreclosure. Absolutely. Right.
Sure.
I mean, make it a win-win. Law of reciprocity. I mean, wins out every time. So that's one way we serve. How do we, serving with a servant's heart, leading with a servant's heart applies to private money. I didn't get this, George. I did not get this, understand this when I started out. Mm-hmm. When I started out raising capital, I didn't realize until I got into it that the private lenders, by the way, these private lenders are not some kind of family offices I'm talking about. Right. These private lenders are everyday people that you go to church with, mm-hmm. That you play golf with, that you go drink Starbucks coffee with. These are everyday run-of-the-mill people. I didn't realize that they need us as much as we need them. Yep. And where else are they going to get? Like I've been paying 8%. Ever since 2009 is when I started in this private money world. And George, my wife and I, we have gotten, I don't know how many handwritten notes over the years mm-hmm. from our private lenders thanking us for changing their retirement years. So it's win-win for everybody.
Yeah. So you have a system in place that you want to go and let people know about that for yourself. If you want to, you have the freedom to work less than 10 hours per week in real estate investing by leveraging the power of automation. So that's what you're doing right now. That's the system that you have for folks to learn about right now. You promote it specifically through the podcast with Raising Private Money with Jay Conner, just Jayconner. And you also have the Private Money Authority on LinkedIn, among other things, but also the website jconner.com. So take a minute to go and talk to folks about the system, how the podcast complements that, and tell us more about what people need to do if they're interested in learning more.
Sure. So my podcast, I'm all excited, George. Now, I heard you say you've been podcasting for 20 years, right?
August will be 20 years, and I've been 30 plus years in media altogether.
That is amazing, George. I'm now in my 8th year of podcasts, and we've got almost 800 episodes so far. But you win the prize. I've never talked to anybody. I've been a guest on over 800 podcasts, and I've never talked to anybody that's been podcasting for 20 years. So you deserve to have the name of your show, King of Podcasts, for sure. But the podcast, my podcast, as you said, the title is Raising Private Money with Jay Conner. And I have 2 shows a week. We release them on all the podcast platforms, early Monday mornings and early Thursday mornings. And I'm always interviewing other real estate investors that have raised private money. And so I interview them. How have they gone about raising private money? What's their favorite ways to raise it, and et cetera? What's their system of raising private money? And so I have 2 different audiences that tune in on my show. Yeah. One audience are real estate investors that want to learn how to raise capital. The other percentage of my audience are actually individuals that want to be private lenders and invest and do, this passive investing. So come check me out at Raising Private Money with Jay Conner. And then in addition to that, George, I would love as a gift to give your audience my book. This is not an ebook. I mean, the Postal Service is actually still in business, believe it or not. Mm-hmm. And so the name of this book is Where to Get the Money Now. Subtitle, How and Where to Get All the Money You'd Ever Want for Your Real Estate Deals Without Relying on Institutional or Hard Money Lenders. I'll autograph it. I'll ship it out 3-day express. And you can pick up the book at jayconner.com/book. Again, that's jayconner.com/book. And as an additional, and by the way, just cover shipping. And in addition to that, I'm going to include 2 tickets with the book to my upcoming Private Money Conference. That's a $3,000 gift. 2 tickets will be included with the book as well.
There you go. Oh, also, the podcast, you can also find it on YouTube. Very important to make that point, the distinction there, because YouTube is almost the end-all, be-all right now for podcasts out there. It's very important. Jay, I really appreciate you taking time out to talk to us about all this. And, there was a show I actually got to produce back in 2005 through, 2011 or something like that, called Domain Masters. And, I was always kind of amazed on people that want to listen to podcasts where they're just talking about money. So there's domains that are being sold for millions of dollars. Oh, we sold this for $2 million. This was for $1 million, this and that. People love to hear about that stuff. And they want to go and hear that idea, even just to get the fever of saying, I could do this. So that's where hopefully people want to go ahead and listen to Jay after this interview and learn more, find out about the system, see how far you want to go. Jay Conner, again, from the Raising Private Money podcast. Thanks for being on with me. Really appreciate it.
Thank you, George.
All right. Thank you so much. God bless. And listeners, we appreciate you listening to another Podcasters Row, and we will talk to you next time.